Hello, everyone. Thank you for joining us today. My name is Suzanne Samid, and I will be one of your trainers today. We'll just give everybody maybe a few more seconds to go ahead and join. And we will also be using the chat. So while we're just kind of getting situated, want to make sure everyone can hear me okay, see us okay, all of that's working. You can also tell me where you're calling in from within the nation. There we go. Awesome. Thank you, guys. Beautiful. Texas, Texas. How's everyone doing in Texas? Give you guys a big hug. Salt Lake City, Washington, nice. Good deal. I am in Shingle Springs, California, somewhere I'm sure no one has heard of. A little north of Folsom. Awesome. Okay, well, let's go ahead and get this party started. So just rules of engagement real quick. We're going to go ahead and use the chat. So there will be opportunities during the presentation where we will go over some scenarios, have some Q&A before we enter into the next category of said training. So if you have any questions, feel free to put them in the chat. I'll ask them once Will is done kind of doing his presentation, and then we'll also do a Q&A at the end. This is being recorded, so you will get the call recording link as well as the actual deck. So you can have this once this is complete. And then this is going to be our third series. So marketing has been kind enough to drop in the chat. Your recording for the first and the second sessions are there as well. So all of this will be available to you afterwards, but just kind of letting you guys know up front. Okay. So in session one, we explored the why behind non-QM, why this market matters, who needs these products the most. And then in session two, we focused on the what and the how, which was walking through key product types and strategies to match borrower solutions. So now in session three, our alt doc deep dive, you'll learn what to look for, what to ask, how to structure these loans with confidence, even when the documentation isn't traditional. From expense factors to ownership percentages and everything in between. We're giving you a playbook to dig deeper, qualify smarter, and say yes more often. So we're going to dive in, master the income side of non-QM because your borrower's bank statements might just be the key to your next closed loan. So I'm going to go ahead and introduce Will, who is our VP of non-QM strategic growth. He is the genius behind this operation. So Will, I will hand this over to you.
Genius behind the operation. That's heavy praise. Thank you, Suzanne. So yeah, today we're going to do some alt doc deep dive. We're going to give you some, kind of real life scenarios, and we're going to tell you kind of the things that you'll need to know. The why would you use these products, and then also what questions should you be asking, your partners out there, whether they're realtor partners or your borrowers. So let's go ahead and jump into it. We're going to start with bank statements. That's kind of, one of the most common product types that you're going to, have in the space or utilize. So why would you use bank statements, right? We've talked about, in general, what you would need to, to accomplish one of these transactions. Now let's talk about why you would use it. So it's obviously for a self-employed borrower, typically with a great CPA or tax professional of some sort that does a really good job of, writing things off, accounting for non-reimbursed employee expenses, and taking depreciation on assets and those sorts of things. What does that mean? Well, your income is going to be lower on your tax returns, right? So it can take a borrower that's very well qualified and move them in those traditional lending options into a no longer qualifying category based off of their income. It could also be that maybe they need a higher LTV, right? This is most common on like an investment property where conventional and conforming guides are going to, cap you to an 80%. Within our non-QM guidelines, you have options up to 85. So if you had a borrower that maybe could only put 15% down, this is a way that we could accomplish a transaction like that. Again, income might be tight, right? Kind of alluding back to those tax returns, something of that nature, or maybe we need a more broad ability to supplement and include additional sources of income without additional restrictions that we may find through those government or conventional or conforming guidelines. That's a way we can do it with non-QM. Maybe it's a non-warrantable condo. Maybe we thought it was warrantable and hey, maybe it's going to be a fallout now, but they still want to acquire the property. Well, this is a perfect pivot over into these non-QMs or bank statements to say, hey, we can do non-warrantable condos. And then again, maybe one of the most important parts of it is to avoid conforming findings restrictions, right? Maybe you get that refer eligible that moves you down to a manual underwrite that you couldn't qualify for, or maybe you get a completely ineligible finding. So we can't go that route no matter what we try to accomplish or do. So these are all perfect examples of why you might pivot over to bank statements. So knowing that now, what should we be asking our borrowers? What should we be looking for? So most importantly is what kind of accounts do they have? What I'm talking about here is, do they have a personal account, a business account, or do they commingle those funds into a single account, right? That can be important, especially with a lender like us, that we have kind of a plethora of investor options that we can kind of put your individual scenarios into. So we want to ask those questions so we know when you're talking to your account executive here with Sierra Pacific, hey, which product is going to work best for you? We have a product that will allow for personal, business, or commingled accounts. We also have other investors that are going to use personal or business only. So, that can be important too, right? So we just want to make sure that we know what types of accounts they want to use, and then we can, more specifically kind of scalpel them into those specific products that are going to work best for them. Pay attention to NSFs or overdrafts. If they do have overdraft protection, that's not really considered an overdraft or an NSF event. But if they don't, we do have restrictions and caps on the number of NSFs or overdrafts that they could have within a 12-month period, typically the most recent 12 months. And ideally, we would like to see no NSFs within that most recent 3-month period, just as kind of an FYI. So make sure you're kind of looking at that when you're looking over these bank statements. I would encourage you to look through those when you get them instead of just sending them to us for 2 reasons. One, then you'll have kind of a better idea what we might come back with. And then 2, you can head some of these things off at the pass. But don't worry, we are still here when you send those in. We can still look through them. We'll, bring those things to your attention if they do apply to your, particular scenario that you send over. What percentage of business do they own, right? Obviously, with bank statement transactions, if they only own half of the business, you're only going to be eligible to utilize half of the deposits from those bank statement transactions if we're going like business bank statements or even on a commingled account. So we need to know that, and it's important for you to know that, so we kind of can set realistic expectations up front of what that income might be. We may show $100,000 a month in eligible deposits, but if they only own 25% of the business, then apply the expense factor. That's only 25,000. Then reduced by the expense factor, it's even less money. So again, that's important to know. Additionally, we do require on our bank statements that they own at least 25% of the business. So again, an important thing to know, if they're coming in out of the gate and they only own 10 or 15%, well, they're not going to qualify for a bank statement transaction because they have to have at least 25%. How long have they been self-employed? Well, that's important to know because on most of these transactions for these self-employed products, we want to see a 2-year history of self-employment. Now, that can be mitigated if they have education or formal training that they went through. We had a scenario a little while back of a veterinarian that had, graduated school and then went in and started their own, veterinary office. They had been doing that for about 13, 14 months, if I recall. So they had the 1 year of self-employment. They had the history of that education or formal training. So we could combine those together. But for those individuals that don't have that formal education or training, we want to see the 2-year history. It just, kind of makes things a little bit more stable in terms of utilizing that income. It gives those investors that are kind of on the back end of these transactions confidence that they know what they're doing. They know how to operate the business efficiently and effectively. Any other income sources? This is important, especially, going back to the why. If income is tight and we need to kind of expand and use some additional income sources, maybe we're going to supplement with asset depletion, or they receive alimony, child support, royalty distributions from a company. All of those sorts of things we can combine on these bank statement or other transactions that we'll go into today to kind of bolster the income and maybe push it across a threshold that we might not have been able to hit otherwise had we gone through those conventional or government guidelines. So it just kind of opens up and lets us build a better and best case scenario in terms of income and the picture that we can put together to kind of formulate this transaction for that borrower. Do they receive 1099s? That's an important one, because if they receive 1099s, and we'll get into that as we pivot over into the 1099 program, if they receive 1099s, it might be better for them to utilize the 1099 program. So that's why I put that in here, just so you can ask the question up front, and then that can tell you, should I continue down this bank statement path, or should I really be looking at 1099s? And again, we'll go into that more here in a few minutes. And then, was the subject property recently listed? Obviously, this is only on a refinance only, but if the property was recently listed, especially if it's a cash out refinance transaction, sometimes that can kind of throw a wrench in your transaction. We typically want to see them off market, especially if it's cash out refinance for a 12-month period. We do have options to do even just the listing being removed. But again, that's another important factor for you to know, and a question for you to ask that borrower. Hey, is your property currently on the market, or was it recently listed? Typically more common for an investment property than necessarily a primary or even a second home. But again, an important question to ask. So let's go into a little bit of the parameters. There's a lot of information on this screen and a lot of data points. I'm just going to kind of give you, some high points here. Obviously, these are all manual underwrites, so the findings don't apply. Now, when you do upload them into the system or our Sierra Pacific portal, Express Loan, you are going to run findings on a lot of these alt doc transactions. It's okay. It's not going to, throw any wrenches in your transaction. Again, these are all manual underwrites. The findings are not going to dictate anything. So we're looking for a 660 plus FICO on these bank statement transactions. You can do up to 90% LTV. Just keep in mind, the lower the FICO goes, the higher the loan amount goes. That changes your risk parameters. So you may not open up that 90% LTV, just depending on kind of where that FICO and loan amount band, falls within. But we do have options up to that 90% LTV. DTI is up to 55%. Again, this is a good one where maybe you fell out from your conforming or conventional guidance. We don't have any findings that are going to dictate that. There's no secret sauce behind the scenes that's running and telling you if it's eligible or not. So up to 55% now. Additional restrictions are going to apply if you are going up to that 55%. Typically, a higher FICO, might be some additional LTV restrictions, those sorts of things. But we do have options for those borrowers that have a kind of a tighter income or a more complex income scenario. And then again, 12 or 24 months personal, business, or commingled accounts. We can do any of those options. Just make sure you're asking those questions so we know what type of accounts they have, and then we can better suit you and your borrower into those specific products that'll work best for those scenarios and those situations. Again, minimum 25% business ownership. And then again, 2 years self-employed history is what we're looking for, but we can supplement with that education or training. And then you can do rate term refi, purchase, cash out refinance, and then a whole plethora of property options: single family residence, multi-unit condo, non-warrantable condo. We have options for rural properties. Now, we typically don't want like working farms where they're deriving income from, the production of the property itself. But if it is a rural property, maybe even if it has some ag, exemptions or agricultural, means to it, those might be doable. Just reach out to your Sierra Pacific account executive. And if they need to get me involved, I'm always here to help as well. And we can kind of walk and guide you through which product is going to suit best for that particular scenario. And then townhomes, leaseholds, single family residence with ADU, all of those things are able to be accomplished here. And then owner occupied second home and investment properties. Again, we went over the investment property on the previous slide, having options up to 85%. So it's a great option for someone that only, has the ability to put 15% down and still meet those reserve requirements, et cetera. Gift funds are okay on these transactions. Now you will have, minimum borrower contributions and things like that can apply. So just kind of keep that in mind. If you have a gift fund scenario, and again, reach out to your account executive. We can help kind of put you into those, best products that are going to suit your particular scenario. And then you can have non-occupant co-borrowers. And then we have a whole slew of supplemental income sources that we can utilize and permit here. We do allow for interested party contributions or IPCs. That can be, maybe a credit back from your realtor partner. It could be credit from the seller of the property. All of those sorts of things to help with closing costs. All of those sorts of things we can kind of apply to these scenarios and these loans. So it really is a robust product and really common sense lending in terms of everything we can accomplish. And then low amounts as low as 100,000 up to 2 million. We are looking to expand that 2 million, but not yet. If you do have an exception that you want to go above that mark, you can always reach out to your account executive and we can escalate it. So it's not to say that we can't or won't. And this kind of pertains to all of the guidance that we have. If you ever have something that doesn't quite fit as you're speaking to your account executive, oftentimes they will say, hey, why don't we just see if we can get an exception on this? So exceptions are very common in this space. So always something that we can, ask the investor, see what their appetite is, and then see what our compensating factors look like, right? Obviously, the higher the FICO, the lower the LTV, how much residual income they have. There's lots of different ways that we can kind of put these scenarios together. And again, if it's common sense and it makes sense that we should do it, the investors are probably going to be in the same headspace and think the same way. Non-permanent resident aliens are acceptable. Some of our products require both a Visa and an EAD card. We have other products that you can do the EAD only as long as it's valid and current. Reach out to your AE if you have questions on specific EAD or Visa classifications that could qualify. We can guide you through that. Reserves as low as 3 months. It can go higher, just kind of depending on your given transaction. But options as low as 3 months are available. We do allow for first-time home buyers and first-time investors on these bank statement programs. So if you were trying to go DSCR maybe on a transaction, but they could have qualified full doc, this might be a good pivot over into maybe a bank statement program, a 1099 program, asset depletion, maybe even a full doc, if they could still qualify utilizing either one of these alt doc or full doc options. And again, they could put as little as 15% down going with one of these product options, as opposed to DSCR, which you're going to have to put down to 20. And then default expense factors from 15 to 85%. We have one investor that's going to utilize basically a grid that determines if you are a service or a product business, and then your number of employees. That will vary your expense factor that's defaulted between 15 and 85%. Then we have two others that always default to 50, right? So it could be a scenario where, hey, based off of this being a product business and 5+ employees, that would default you to an 85% expense factor. Let's pivot over to one of our other two products that default to 50, and then we don't have to worry about going all the way up to an 85 on that product, right? So this is, again, where your account executives, myself, if they need to get me involved, we can really help you kind of sort through, all of this information that we're providing and kind of put you into the best case scenario for your borrowers to make sure that your transaction is as smooth as possible. We can mitigate those expense factors down to a floor of 15% on the product that uses the grid that we were referencing, and that was on our previous presentations. And then we can go as low as 10% on our products that default to 50. However, if you are trying to mitigate those expense factors, we will require a CPA letter that will kind of show us what their actual expense letter is or expense factor is. So just keep that in mind. We do not require a CPA letter on every transaction, but if you are trying to mitigate that default expense factor, we would want to see that CPA letter, again, with some conjecture on here's their income, here's their expenses, this is their factor, right? And as long as those bank statements make sense with what we're seeing on that CPA letter, absolutely we'll move forward with that transaction. So let's get a little bit into the income calculation, right? We've talked about all the things we can do, kind of a brief overview of kind of how the income could work, percentage of ownership, those sorts of things. Let's talk about how the income is calculated. So what we do when you send us the bank statements, or you could do on your own if you wanted to give it a shot, is we'll take all of their eligible deposits. And the reason that we put the moniker in there of eligible deposits is because sometimes, like, I know I've been on vacation and had friends stay, and they'll kind of like Zelle or Venmo me some money back. Obviously, those aren't business transactions. Those aren't going to count, right? They're not going to be eligible. So what we're really talking about is eligible business deposits that come in. So anything that we can count that looks like it has something to do with their operation of their business and their income, then obviously that's an eligible deposit. We're going to add that into the total. So we take all those eligible deposits, we add them up for each month, and then we kind of combine that into a 12 or a 24-month total. Then we're going to take that and multiply it by their percentage of ownership, and then we're going to multiply that by the expense factor applied, whether that's 15 to 85 on the one product or the default 50 for the other two products. And then we're going to divide that by the review period, either 12 or 24 months. So a quick example, say you had $1 million in eligible deposits. You had 25% ownership, you used a 50% default expense factor, and it was a 12-month business bank statement transaction. So $1 million in deposits times 25% for their ownership percentage. Then you're going to take that, multiply it by 50% for their default expense factor, divide by 12 months, which is the period that we're reviewing. That would give you roughly 10.4 in monthly eligible income. So that would be the income that we would be allowed to utilize to then calculate our DTI ratio, cover our other expenses, the new monthly mortgage payment, etc. That will kind of give you a picture as to this is how we do things. So again, as you're kind of reviewing those bank statements, you'll kind of get used to looking for those eligible deposits, asking about the percentage of ownership. We'll apply our expense factors that are default, and then, hey, here's our monthly eligible income. Again, if for some reason you had a CPA letter or similar that we could mitigate that default expense factor, we could go lower. But this just kind of gives you a quick example as to, how's the sauce made, right? What are the ingredients that go in to kind of give us our monthly eligible income? This is it. Let's go into a few use cases here. So we've got some use cases that we're going to go over, and this will just kind of give you a quick look. And I'm going to ask you a quick question as we go through these. So Suzanne, I think you're jumping back on.
I sure am. Yes. So we did have a quick question in the chat that I wanted to ask real quick. How many NSFs can they have in a 12-month period?
So you're typically looking at a maximum of 6 within a 12-month period, and that's with 0 in the most recent 3 months. Now, what I will say is if you have an instant of an NSF in the most recent 12 months, that maybe it was, they got their account down really low and they made like 5 stops throughout their day, and they had an overdraft for $1 because they bought a pack of gum and $10 for lunch. And, these numbers are probably a little low in today's, cost of things. But let's say you had multiple of those, transactions in a single day. That's one instance of an NSF. It wouldn't be 5 for all 5 of those that happened on the single day, right? So really you're looking at kind of in a single day, how many NSFs did they have? You're not looking at that. You're looking at how many NSFs over, multiple days did they have over that 12-month period. So really they get kind of 6 days, but you are looking at those instances of NSF. That's what you're looking for.
Awesome. Good deal. Thank you, Will. And
Absolutely.
then there was a question from Sean, but I'll just wait. I just wanted to clarify, Sean, on that one, that he is now considered self-employed. So I can answer that in the chat.
Okay,
But I'll
great.
go ahead and hop on over to the scenarios. And then, like Will had already mentioned earlier, we'll go over a couple of scenarios in each category. As you guys have specific examples, I'm sure we're all ready for all of them. What I would suggest doing is sending them directly to your AE, and then they'll filter it to our team. So behind your wonderful and amazing AEs is a whole team of people that care. We've got a phenomenal scenario desk, our jumbo team. So if you guys do have specific examples that you really want to look into, please send those to your AEs, and then they'll get the back of the house working on it for you and see if it's something that we could do for you. So
Yes,
we'll do
absolutely.
scenario one for bank statement. So it's going to be purchase primary, 950,000, 700 FICO. LTV is going to be 85, or DTI is that dreaded 50. Property type is going to be a single family with an ADU, threw in a little sauce there. First time
Okay.
home buyer is yes.
Yep.
12 months personal bank statements provided, and it's a suburban area at a quarter of an acre. Is that something we could do?
So let's see some ones or zeros in the chat. One if you think it's able to be accomplished, zeros if you don't think it's able to be accomplished. Let's see out there what everyone's thinking. All right. Yep, I like it. You guys are hitting it on the head. John,
Yep.
Gaurav, Sebastian, Mary. Yep, you guys got it. So this transaction would be eligible. Now, the one caveat to this, since we threw a little sauce in there to steal your thunder, Suzanne, as long as that ADU is following Fannie Mae guides, then we'd be good to go. So absolutely something we can accomplish and do. All right, let's see what our second
Awesome.
for us.
So this one is going to be a rate term refi. This one is a second home, $400,000 loan amount. FICO is going to be a little bit lower at 660, solid LTV at 70%, DTI again 50. This is going to be a single family detached. This is obviously not a first time home buyer, and they're going to do 24 months personal bank statements, also in a suburban area at 1 acre. Can we do this?
All right, ones in the chat if we can, zeros if we can't, guys. What are we looking at? Let's see who's batting 1,000 here.
Right?
I
They all
like it.
are.
Yeah, I see a lot of people batting 1,000. Sebastian again, Gaurav, Derek, Emma, nice. I like it. All right, so yes, eligible. This fits well within the realm of what we can accomplish. Again, you have a little bit tighter LTV because of that lower FICO score. DTI can still be up to that 50% threshold, no problem. Nothing else really in terms of any curveballs here. The only other thing we'd have to do is just calculate those bank statements for the income purposes. Everything else fits well within the box. All right, let's go to scenario
Perfect.
3. What do we got?
This one also refi cash out. This is an investment property, $400,000 loan amount. Again, a little bit lower to 660, 70% LTV, DTI curveball at 55. It's a single family detached, obviously not a first time home buyer. They're going to do 24 months personal bank statements. This is a rural area, another curveball, and our acreage is 18.
All
Terrible
right,
to manage.
ones for yes, zeros for no. What are we thinking? Sebastian says no. Mark says yes. Mary says yes. Robert
Can I
says
put like
yes.
a 3 in there for a maybe? Can I do that?
No maybes, no maybes.
No, maybes? Okay.
All right, I see some no's. All right. So this one would not be eligible. The reason, because the property is rural and the occupancy type is investment, and the purpose is cash out refi, along with, in combination, the DTI is greater than 50%. So several things here that are making this ineligible. Now, had you moved this DTI down to 50%, had you said it was a primary, all of those sorts of things kind of change that risk profile. So that would potentially move it over into the eligible category. But when you're combining all of these things together, the high DTI, the fact that it's a cash out refi investment and rural, that makes it not eligible. So not eligible on this one. Thank you, Suzanne.
Of course.
Nice job in the chat, guys. I saw several of you batting 1,000 there, so well done, well done. All right, so now we're going to pivot to 1099s. Why would you use 1099s? So this is for your contract or gig workers. We've talked about in our previous iterations of these trainings how important this is, the growth that's coming, projected to kind of really skyrocket around that April to June timeframe of 2026. We've already got a lot of these people that are going for this gig type of work, and kind of these Gen Z or millennial borrowers. So it's important to know about this stuff. So again, maybe they have a great CPA or tax professional that's taking a bunch of write-offs, non-reimbursed employee expenses. Maybe they have assets that they're appreciating. That's a perfect case scenario for utilizing this 1099. And a cool thing that we'll get into here in a minute, as it pertains to the 1099, is lower default expense factors as well. So if they have the ability, this is kind of like we talked about on the previous bank statement, slides. If they have the ability to go 1099, I would almost always encourage you to take them this path, just because that lower default expense factor of 10% is going to get you a lot more income just right out of the gate for doing this program as opposed to bank statements. So again, using more of the borrower income to qualify. So maybe you need a higher LTV, like we talked about previously with bank statements, up to 85% on investment properties, avoiding some of those restrictions. Again, if your income is tight, all of those same ways that we can kind of supplement income that we did on bank statements, we can do again here. So it's a great way to kind of, get that additional income, create a unique picture for these borrowers, and really flush out all of the possibilities with this common sense lending options. Again, non-warrantable condos eligible. You can avoid those conforming findings on those refer eligible or refer ineligible findings. So you don't have to pivot down to a manual underwrite through Govy transactions, et cetera. So a lot of different ways that we can kind of stroke this brush and paint a better picture for these borrowers to give them as much as possible and really open up and flesh out their possibility in terms of what they could borrow, what they could qualify for. So what should you be asking the borrower, and what should you be looking for? Do they draw income from 1099s, right? It's the most simple question possible. Do you earn income on a 1099? If they do, this is probably the first place I would look. Doesn't necessarily mean this is where we'll land. Maybe there's some other things there that we kind of have to look at, and maybe bank statements would be better or a different option. But this is where I would start if they do draw a 1099 from one or more companies out there. And we say one or more because if it's commonplace in their industry and they receive more than one 1099, that's still a possible transaction to be accomplished. Any non-reimbursed expenses, right? So, maybe their job is to drive around and deliver things, and they don't have fuel or some of those things reimbursed, then that would be a non-reimbursed expense. However, maybe they receive something like a per diem daily that covers like a hotel and food and gas, travel expenses, those sorts of things are reimbursed to them. Then those are obviously expenses we wouldn't have to account for. So, lots of ways that we could, even mitigate that expense factor if we can prove that they don't have any non-reimbursed expenses or they don't incur any expenses themselves. What type of 1099 do they receive? That's an important one. We're going to go over on the next slide all of the different types of 1099s that they could earn, and then we'll highlight some of the most common ones so you can kind of know, hey, this is probably something that would work as opposed to maybe a 1099 that wouldn't work. Any other income sources, right? So in the same ways that we could supplement income from those or on those bank statement transactions, we can do it here as well. Maybe they have asset depletion. Maybe they have a co-borrower that earns W-2 income. Maybe they earn W-2 income, but they work in an industry where it's commonplace. On the previous presentation, I've given the example of like a police officer who moonlights and does, security details or security work for maybe a bar or nightclub, something like that. That's commonplace in the industry. That's something that we could look at and potentially accomplish for that borrower, even combining for the same borrower. And then again, was the property, subject property recently listed? Obviously only a refinance. Does this apply to? But another important question to ask, just so we can avoid any of those speed bumps or hiccups as we kind of move through the process. So let's take a quick look now at some of the types of 1099s. There is a lot of them, right? So most common types of the 1099s are going to be at the top here. So you've got your NEC, your miscellaneous, your dividends, your Bs, your Rs, your Ss, your Ks, lots of different types of 1099s, right? So most important ones I would look at is your NEC or your miscellaneous. Obviously, those are going to be specific to businesses, right? So right out of the gate, that should tell you, hey, this is probably something that's going to work or qualify. Maybe slightly less common is like a div or a B for brokerages or exchanges or corporations. Maybe they're receiving dividend income, right, or capital gains distributions. That's going to be on a 1099 div. But a really cool thing about this 1099 div is, let's just say you had someone at Apple that owns 10% of the company. Can't do bank statements because they have to own 25% of the company. Can't do a P&L because they have to own 50% of the company. But do we really not want to do a loan for someone that owns 10% of Apple? I know I do. I'd loan them every dollar I had because the likelihood of them repaying that loan is very significant, right? So a way that we can kind of circumvent those other guidelines for those other products is, hey, do you get a 1099 div for your 10% of ownership of Apple? You probably get capital gains distributions. That's a great way that we could still do a loan for that borrower, while again, avoiding the additional restrictions that we might have by using one of the other alt-doc products. Again, reports from 1099R, so reports from distributions for pensions, IRA, 401k. That's another good one from like a retirement plan provider. Maybe they're, kind of in the twilight of their career. Maybe they're not working anymore, but they're getting those distributions. They've hit that retirement age. They're getting those distributions. Well, hey, we could use this maybe as a primary source of income, especially if they don't have enough assets to do maybe something like asset depletion. This is another way that we could utilize those things to, or these 1099Rs through a 1099 program to, perform the transaction for that borrower that has income, but they need an alternative way to show that they're getting that income. And again, if they're taking those write-offs or they're taking those depreciation on assets, things like that through their tax returns, they may not show enough income. However, if you pivot it over and utilize this 1099 program, that might be the perfect way to be able to accomplish that transaction for the borrower. And then you've got a lot of other less common types of 1099s, right? So like 529 plans is something that we have for our children. You're not going to really derive any income from that. So that, and a lot of that is, a one-off or maybe a 1099C for like some sort of cancellation of debt or debt forgiveness that occurred. I know, with the whole student loan forgiveness, a lot of people receive those 1099Cs. That's not a source of income, right? That's kind of a one-off sort of thing. That's not something we're going to be able to use. So if you do have any of these that are kind of highlighted in that yellow, those are the 1099s I would focus on. Those are the ones that are going to kind of give you the best case scenario in terms of being able to accomplish one of these transactions. So let's look at the parameters. So again, we're looking at very similar parameters here to the bank statement program. 660 min FICO. These are all manual underwrites, so no findings apply. Or we're going to dictate anything up to 90% LTV, 55% DTI. Again, we won't go through the laundry list. A lot of this is going to be a direct, mimic from the bank statement programs. One thing I will draw your attention to here is obviously one or more eligible 1099s for one or more years. So the important note here is if they're earning money on a 1099 currently, but they have not yet received a 1099 because they typically come out at the end of the year or maybe at the end of a contract, that's where you kind of have to be careful, right? If they haven't received the 1099, then there isn't a 1099 that exists for us to calculate the income off of, right? So if you have the 1099s received and you can prove receipt of that type of income for one or more years, then that's a transaction that we could do. If they've only done it for a few months and maybe that contract ended, they've got one 1099, but maybe it only covers, let's say, year to date, that's not something we're necessarily going to do. We do want to see at least that 12-month history of that type of income. Again, just creates that consistency, kind of like with, bank statement transactions and being self-employed. It kind of gives, that investor the feel good, if you will, in ensuring that they understand that line of work, they understand that line of business, and they can operate within it effectively and efficiently to make sure their bills are paid. And then again, default expense factors here down to 10%. So we can mitigate that. So if you provide what we refer to as the business narrative that is prominent on the bank statement transactions as well, and you do a good job of explaining their business type, that they get their expenses reimbursed, those sorts of things, then we could completely mitigate that expense factor. Otherwise, you're still getting 90% of the income shown on those 1099s right out of the gate. So let's jump into, we just talked about kind of, the expense factor. How does that equate to, the income calculation, right? So there's no percentage of ownership, incurred on this one. So it's a really simple calculation. Total eligible income on their 1099s, apply the default of expense factor, typically of 10%, but can be mitigated. And then divide that by the review period, either 12 or 24 months, right? So 200K in eligible income from one or more 1099s, apply the 10% default expense factor, divide that by 12 months. So 200K in income times 10%, that's 20K in expenses. 200K in eligible income minus the 20K gives you 180K in eligible income. Take that 180K divided by 12, you got $15,000 a month in eligible income. About as simple as it gets in terms of, income calculations for these alt-doc programs. All right, Suzanne, we're back to some use cases, unless you've got a question or two for me before we jump into it.
I do have a question or two for you.
Perfect.
So we have a request. Will you have a class and show us how to upload the application and upload the statements? Show us how to proceed once we get the 24 months bank statements, and what to put on the application and what not to put on the application.
Yeah, so a part of this series won't be going in depth into like system use. However, we can absolutely set up a training either one-on-one or with your organization, and we can walk you through how to do that. Either one of our account executives that's representing you here with Sierra Pacific, or one of our sales assistants that are very knowledgeable. Basically, any of us could show you how to do that. Absolutely, and again, we can do that as a one-on-one. Or, we could set up kind of a company-wide training with, your LOs and processors, whatever you may need.
Awesome. We have another question. Do you have to show continuance if the contract ends? I assume that 1099 income is invalid.
Yes, we do want to see continuance. So there are instances, we had one not too long ago, a student athlete, right? But he only had 2 years left on his contract through these new, kind of agreements that they have, these collective bargaining agreements, if you will, through the NCAA. But he only had 2 years left of eligibility, so we couldn't create that 3 years of continuance. So yes, there are those restrictions to be able to show continuance. Now, if it's not a contract or if it's an auto-renewing contract, as long as both parties agree, then I would say that, that would be eligible. But if it has a hard set in stone, the contract ends here without, further notice from the company, then yes, that would be something where we would have to have something showing that they were going to continue on that path or that type of income. Yes.
Awesome. Thank you. Does Sierra have any 1 or 2-1 buy down options on owner occupied purchases for bank statement or 1099 program?
We do not currently. We had an investor that was opening that up and offering it to us. They've pulled back on it for whatever reason, their prerogative. But it is something we are looking to kind of reintroduce in the future.
Awesome. Can it be a recording? Oh, yes. If we do that training, we absolutely can do a recording of it. So for anyone who's not able to make it, you can come back and refer to it. 1000%.
Absolutely.
I get referrals for doctors here in California. It's normal to get a 1099. This client came from New York with 18,000 for a week. How do we prove as almost a premium?
So I'm not sure, on the almost a premium, but if they are receiving a 1099 and they're showing, 18K a week, I'm jealous. That's great income.
Right.
But hey, if they have the 1099 showing that they've received that income and they've been doing it consistently, over the 1 or 2 year period, whatever their desired look back term is, that's absolutely something we could do. And it sounds like they're very well qualified in terms of their income amounts.
Yep. And then kind of along the same lines, another doctor just finished his 13 years of schooling. That's why they make the big bucks. And he's offered a 4,000 a day working remotely. So how do we qualify that on 1099?
So I would say if he's going 1099, but does not yet has not yet received a 1099 for his new contract or whatever the case may be, if we didn't have a history of 1099s, then I would say it wouldn't be income that we could use on a 1099 program. However, maybe we could use bank statements, or maybe we could even go full doc and utilize that contract for employment. It just kind of depends. So what I would do with that specific scenario is, let's get with your account executive. If you guys need to get me involved, happy to jump on. Let's talk through it and kind of dive a little bit deeper into that specific scenario to make sure that we're kind of covering everything that we need.
Perfect. And marketing, it just told me to zip it and move it along. So
Got
I'm
it.
going to do that.
All right.
Thank you, marketing. All right,
Well,
scenario. So rate and term refi for a primary, it's $550,000 loan amount, 740 FICO, 90% LTV, 48% DTI, single family attached, obviously not a first time home buyer, 1 year 1099s, and it's multiple 1099s. We also have supplemental income with co-borrower for W-2 and then child support and alimony. This is urban and 0.32 acres. Can we do this?
right. Again, ones in the chat if you think we can, zeros if we can't. And we're going to go pretty quick on this one. So brace yourselves.
I'll read quick.
I already see the ones.
Marketing.
I already see the ones. Yes. Assuming it's commonplace in their industry to receive multiple 1099s, absolutely something we can do. Absolutely something we can accomplish.
Second scenario, purchase primary, $550,000 loan amount, 740 FICO, 90% LTV, 52% DTI, condo, warrantable, there's a plus. Obviously not first time home buyer, 1 year 1099s, again, multiple 1099s. We also have the co-borrower with the supplemental income for W-2s, child support, alimony, and it is an urban area. What say you?
What are we thinking? Ones in the chat for yes, zeros for no.
I like that too.
I think I got them on this one, Suzanne.
I think so.
It is ineligible. Condos are capped to an
Correspond
85% LTV. Changes the risk. Yeah, I see your 3 there, Suzanne. Yep. So condos are capped to an 85% LTV. Keep that in mind, even if they're warrantable. So, all right, number 3.
All right. Rate and term refi, second home, $750,000 loan amount, 660 FICO, 80% LTV, 48% DTI, condo, also warrantable. First time home buyer is yes, 2 year 1099s, asset depletion, little layering, and it is in an urban area.
All right, ones for yes, zeros for no. What are we thinking? This is a little bit more complex. We know the LTV qualifies now, but it is a second home, does have asset depletion added. All right, I think they got it. Yep, it's eligible. We're good to go.
Beautiful. Good job, guys.
Thanks, Suzanne. All right, let's jump quickly into profit and loss here. So profit and loss, this is one of the easiest products to utilize because we're not applying additional expense factors or anything crazy. It's already determined in the profit and loss statement. So again, not unlike bank statements and 1099s. Why would you use profit and loss? Well, one of the reasons you might is because your bank statements show too many NSFs, right? Maybe they're a self-employed borrower who has a great CPA or tax professional, like we've talked about before, write-offs, depreciation, etc. We need a lower expense factor, right? If you're already going to that CPA for a CPA letter to lower or mitigate the expense factor, hey, use the profit and loss. Just ask them for a P&L. Less overall documentation. You're just collecting the P&L as opposed to 12 or 24 months of bank statements that can have 10 or 15 or 20 pages each. Need a higher LTV, again, up to 85% if you're going on an investment property, etc. maybe your income is tight, maybe it's a non-mortgable condo, or you're trying to, again, avoid those conforming findings. So similar reasons, but it is a good way that maybe you could pivot away from bank statements if you have those NSFs like we talked about earlier and we got the questions on. So, what should I be asking the borrower? What percentage of the business do they own? They need at least 50% for a profit and loss. How long have they been self-employed? Need that 2-year history, right? Any other income sources? We can still supplement these income sources, even on a profit and loss, with all of these other options: W-2 for a co-borrower, asset depletion, alimony, child support, royalties, all of those sorts of things. And then again, was the subject property recently listed for a refinance? It's always important to know, just because it could move or shift our product into a particular investor. Here's your parameters. Now you'll notice here, we do have a change that we haven't seen yet. So for the P&L program, we're only allowing up to 80% LTV. DTI is still up to 55%. There's still a manual underwrite, so no findings are going to apply or dictate here. We're looking at the 12 months most recent profit and loss statement. Not last year's, not year to date this year, but if they have last year's and a year to date, that can suffice, but we would need both. But typically we're looking at from, the day that you submit that to us, looking back 12 months, that's typically what we want to review. Again, they do have to own at least 50% of the business. We do want to see that min of 2 years self-employment history. And then all of the other parameters that we've had on our previous 2 products as well, we kind of have here. 100K min loan amount up to 2 million, non-permanent resident aliens, reserves as low as 3 months, gift funds okay, non-occupant co-borrowers. All of those other things are still going to apply to this program with those additional caveats that we just went over. And then your qualifying income is going to be based on the lower of the 12-month P&L or income disclosed on the initial application. I wanted to put that on here because a lot of people will just kind of guesstimate and then put a number in. So I would always say, hey, go a little bit higher in terms of, your estimate. That way you're never hindering or hampering what, that borrower could qualify for based off of what you put on the application, or have us, pre-qual or pre-calc that income for you, and then you can put the more accurate number on there. Reach out to your account executive if you, want to get that accomplished and have it pre-calced for you. All right, so now that we've talked about, how much of the business they have to own, et cetera, let's talk about how we calculate the income. Obviously, it's the bottom line income noted by the CPA, or the net, and then you're going to obviously, take away your percentage of ownership, and then, or the percentage that you don't own, and then you're going to do your, review period, whether it's 12 or 24 months. Typically, it's the most recent 12 that's being reviewed. So 1 million in revenue on the P&L, 200K in expenses on P&L, 100% ownership, 12 months review period. So 1 million in gross revenue, minus the 200K expenses, 800K on the net revenue on the P&L. You're going to take that net revenue, multiply it by the percentage of ownership, in this case 100%, so you're keeping the 800K, divide that by your 12-month period, roughly 66,000 and change per month in eligible income. So very simple calculation on that one. The only time that you really have any additional, caveat to dividing that net revenue by that 12-month review period is if for some reason they don't own 100% of the entity. All right, Suzanne, let's do our use cases real quick.
Ready, go.
All right.
Scenario 1. So this is a purchase, primary, 800,000, 668 FICO, 80% LTV, 40% DTI, single family detached, first time home buyer, 12 months P&L, and then there's no supplemental income, and it's a suburban area, 2 acres, and then also I'm going to sneak this in, does the P&L have to be audited?
I love it. Robert's already on the ball. He's already said yes. So quick answer, yes, it is eligible. All right, let's go to the next one here.
Cash out refi, primary, $950,000 loan amount, 740 FICO, 80% LTV, 55% DTI, warrantable condo, not a first-time homebuyer. They are opting to go the 12-month P&L route. We do have a co-borrower who's using supplemental income, which is wages and asset depletion, and this is also in an urban area.
All right, what are we thinking? I see some zeros. Oh, I got you guys again. This is eligible. Absolutely. So we know we're under the 85% threshold in terms of condo. It's warrantable, so no additional caveats or restrictions there. Even though the DTI is higher, we're still, at an 80% LTV with a 740 FICO. So yeah, absolutely something we could do. All right, last one
Good
here.
deal. Last one, cash out refi, primary, $950,000 loan amount, 698 FICO, 80% LTV, 55% DTI, also a warrantable condo, first time home buyer is yes, 12 months P&L in a suburban area.
All right, what are we thinking? See some zeros, see some ones, zeros, okay. Looks like a mixed bag on this one. So this particular scenario is going to be ineligible. It's because the DTI is greater than 50% and the FICO is less than 700. So a little bit of a curveball there. The important thing to note here, guys, is look, some of you are putting ones, some of you are putting zeros on some of these. Sometimes you're right, sometimes you're wrong. But the good news is that if you're wrong, we can do more and accomplish more than you thought we could. So just keep that in mind. Reach out to your account executives. We'll steer you in the right direction. All right, asset depletion. Let's talk about it. So asset depletion, why would you use it? It's standalone or supplemental source of income. Maybe it's a twilight borrower who's left the workforce and has no other income source. If supplementing income, this could be the difference between qualifying or falling short on income, right? Talked about the scenarios earlier where maybe the income was tight. So what should you be asking the borrower? What should we be looking for? So how much does the borrower have in eligible assets to deplete? So it does vary by product. What I would say is typically you're looking for somewhere around $1 million or 125 to 150% of the loan amount, or a very convoluted, calculation based off of their debts over a 60-month period. So if you have those assets, if you don't hit one of those first two, bullet points, whether it's $1 million in eligible assets to be depleted, or that 125 or 150% of the loan amount, reach out to your account executive. We have a calculation that can sometimes work, looking at their monthly debt obligation over an asset depletion period. So that's, an important note there. Is the borrower 59 and a half or older, or 59 and a half or under? If they're 59 and a half or older, they may have less factor that we would apply to their assets depending on their type. So if they're 59 and a half or older and they're doing depletion of retirement assets, then they're obviously early withdrawal penalties, tax obligations, etc. We may not have to apply those if they're 59 and a half or older. So just keep that in mind. And then what types of accounts are the assets held within? Why do we need to know that? We'll get into that in a second. All right, asset depletion. Again, a lot of the same things here that you've seen on the previous slides in terms of, loan amount, min-maxes, gift funds, all of those sorts of things, property types, transactions you could use it on. But keep in mind, up to an 85% LTV. This is if you're using asset depletion as a standalone product. If you're using bank statements and supplementing with asset depletion, you're still held to the qualification standards of that bank statement program or 1099, et cetera. Or even a P&L, which could be a lower LTV if you were using that as your primary source of income and then supplementing with asset depletion. DTIs up to 55, again, all of those sorts of things. Assets depleted over as little as 60 months, depending on the product that we might need to put you in. It could be a 60-month review period. We also have a product that defaults to an 84-month review period. So just depending on the scenario and what that borrower needs, we may have that. A couple other things that I'll draw your attention to is no reserves required for asset depletion. So you're already accounting for that in your parameters of the loan. So we wouldn't have to have any additional reserves in order to qualify you. So here's the income calc. This is where I was talking about, those haircuts that we would take depending on the type of account that the assets were held within. 100% of checking, savings, money market. The easy answer to this is, hey, there's no tax obligations. There's no early withdrawal penalties. You get 100% of that. Stocks, mutual funds, bonds, 80% of that because you could have tax obligations. 70% of retirement because you could have tax obligations and early withdrawal penalties. Again, for those borrowers 59 and a half or under. Quick example, 250 in checking savings, 100K in stocks, 700K in retirement accounts. Here's the quick math on that. You're getting 100% of the checking savings, so 250. You're getting 80% of those, stocks, so you're getting 80K, and then out of the 700K of retirement assets, you're getting the 490K because in this scenario the bar wasn't 59.5. So you take that 820K, adding up those three numbers, divide that by 60 months, assuming we're using that 60-month product, 13,666.67 a month in eligible income. And again, assuming those assets are at least 125 or 150%, depending on the product, or we're hitting that $1 million in eligible assets moniker. All right, Suzanne, it is on you again.
Speed reading, here we go. Purchase primary, $800,000 loan amount, 660 FICO, 80% LTV, 49% DTI, single family, detached, first time home buyer is a yes. We're going asset depletion, no supplemental income, and it's in a suburban area under an acre.
Okay, I already see some ones in the chat. Yep, you guys are on it. You got it. Absolutely eligible. All right, next one.
Purchase investment, $900,000 loan amount, FICO 743, 80% LTV, 36% DTI. Ooh, curveball, 4-unit. First time home buyer is yes. Also asset depletion. We have supplemental income with a co-borrower who has wages, and this is in an urban area, also under an acre. Oh,
all right, well,
looks like this one.
Yeah, it looks like the most of them got it, but Mark, yeah, we are eligible there, bud.
Through me too, Mark.
I know the 4-unit was a little bit of a curveball, but yes, that is an eligible transaction. All right, scenario 3.
Cash out refi, also a primary, $950,000 loan amount, 690 FICO, 80% LTV. DTI is going to be 55. This is a condo, non-warrantable. Curveball, not a first-time home buyer, asset depletion, and in a suburban area.
Okay, I like the 2s. That's great. So on this one, we are ineligible. It's cash out refi on an investment with greater than a 75% LTV. Additionally, which I didn't put the note on here, but your DTI is above 55%, you don't have a 700 FICO. All right, nice job.
Get that FICO up, guys.
Yeah, you got to boost those numbers. Those are rookie numbers.
Right?
All right, any additional questions in our chat here, Suzanne?
I don't see anything that we haven't covered. Great participation. Thank you, everyone.
Yeah, we appreciate it.
Fantastic. Awesome. They appreciate the scenarios, all that good stuff. So just to recap, we will be sending you all these goodies. So you'll get the recording, you'll get the deck. You have your wonderful AEs and an entire team here at Sierra Pacific that's happy to help you with anything you need. And I'm going to go ahead and turn it over to John, the best McCash, who is our executive leader for our TPO sales division. And he truly is the best.
Suzanne. Awesome. Well, I know we're over, so I'm going to just take 3 minutes for my pitch. No, 2 minutes. So just stay on for 1 second. So again, thanks, Will and Suzanne, for the amazing content and the really engaging interaction. I love the ones and zeros. It's kind of like how my kids text me responses when I text them about something. They just respond in 1 or 0. So this is good. I mean, I'm used to seeing that. So that's great. Now, all seriousness, thank you for investing your time in learning non-QM. It's really important, as we continue to build non-QM here at Sierra, we provide you, the client, the resources necessary to win in this segment. Non-QM is about 8 to 10% of the entire mortgage market today and continuing to grow. So look, our primary goal here is to give you more reasons to say yes to your borrower. So if there's 3 things you can take away, besides the DTI at over 55% and a credit score needing 700 credit score, if there's 3 other things you can take away today from the call, I break them into 3 areas: the needs, the options, and the actions. So the needs, self-employed borrowers and borrowers with diversified income sources are growing at exponential numbers. So this type of borrower is here to stay. They need options, they need solutions, and originators today in the market have a better product set today than in the last 10, 15 years. So take advantage of that when it comes to the needs in the market, the options and income types, bank statements, asset depletion, 1099 income, P&L. You have so many different options to help borrowers get into homes or refinance existing homes. There's more products out there, like I said before, that can fit some of these unique financial profiles. And there's more lenders out there. We think it's great. We love the competition today in the non-QM space because it really pushes everybody to invest in the non-QM business and the channel to ensure that all of you are supported to fulfill the non-QM originations that you're bringing in. And then the last thing is the action. Look, embrace non-QM. It's new, it's different from agency and government, but it is here to stay. So connect with your Sierra Pacific account executive, learn how we can support you on your non-QM journey. Will Davis, Suzanne Samid, both available to help also problem solve as well when needed. Expand your referral network. Another action I would highly suggest you look at CPAs, divorce attorneys, other professional networking groups where you can tap into people who are either self-employed or utilizing some of these other diversified income sources. And then lastly, join our webinar on August 13th at 2 o'clock Eastern time or 11 o'clock Pacific time. That session will cover all things DSCR and investment properties. The investment property market continues to grow due to rent prices across the United States. And one little tip with some recent budget legislation that passed the House and the Senate last week in Washington, there's actually some very, very beneficial items coming from that for people that own non-owner occupied properties and borrowers who are making capital improvements to their property. So there's been a change in the way in which borrowers take advantage of deductions for capital improvements that can really benefit the tax schedule for each one of those borrowers. So you want to tune in for that and learn more on August 13th. So again, a big thank you to Will and Suzanne again. You guys did an amazing job, great content. And then thank you to all of our clients who attended the webinar, invested in their future, and are partners with Sierra Pacific. So thank you again and have a great day.